Tesla stock reversed course today after a 7-day losing streak, paring back some losses after a brutal month and year for the stock. It's fallen over 71% since the beginning of the year, marking a decline of $900 billion of lost market value. Market pundits attribute this crash in Tesla to a host of possible reasons, namely that Elon Musk's actions on Twitter have somehow tarnished his name and the Tesla brand, which has led to weakening demand and calls for Elon Musk to step away from Twitter or Tesla to help focus his efforts. However, as convincing as they sound, most of these claims are completely nonsensical and are meant to shake investors out of Tesla stock and cause havoc for the company. But Elon Musk seems unfazed regarding the decline in Tesla. So what's the real reason that Tesla stock has been beaten down to new lows just in the last few days? And do any of these ultra-bearish arguments hold any water? What happens if something positive shines through all this negativity? And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. The author of Jaws, Peter Benchley, was opposed to Steven Spielberg's plan to have the shark blown up at the end, arguing that it wasn't feasible and certainly not believable. However, Spielberg believed that by manipulating the emotions of the audience for the previous 2 hours, he had gained their support throughout the journey, and they would be willing to accept the shark being destroyed at the end of the film. And indeed, he was right to change the ending of Jaws to be a crowd pleaser, as unscientific as it may have been. Now, over at least the past year, Tesla stock has been slowly losing value, with rumors building that there are issues at the company. Now that the stock price is down significantly, those voices have gotten louder and louder. Every bear thinks they've been right this entire time, and everything they're saying seemingly gets believed, because there must be a reason that Tesla stock is down so much. Last week we heard bearish Tesla analyst Craig Irwin state that Tesla's FSD computer used more power than the actual motors in the car, all while trying to give Tesla advice that he wanted to see with the company. We showed that Craig's calculations were off the walls. Now, for some reason, the bulls are also pushing for a shakeup of Tesla's board of directors, and that Elon Musk basically can't manage his time properly. And that if Elon Musk tweets about free speech and upsets some people on the internet, it somehow relates to tarnishing Tesla's brand. It seems that anything that anyone says about the company is now believed and has become part of the rhetoric, and yet we're just coming to the end of the final quarter of the year, and no one yet knows where Tesla's results will stand. Elon Musk has commented with the thinking emoji on the hypothesis that Tesla could have a very solid quarter and add $4 billion to their cash pile. He seems very confident that things will work out okay, saying that Tesla is well positioned with their $20 billion cash pile and virtually no debt. If we're in or entering a recession, Tesla is in a position to continue investing in their business while other large players cut back on their expenditures as they get hit much harder, given that the market is indeed shifting to electric vehicle sales, which continue to grow as ICE sales decline. It's also important to note that we've actually had quite a few disruptions this year, especially in the second quarter, which affected deliveries in China. Now we're poised to see Tesla's overall volume grow to over 400,000 units for the first time in a single quarter, up from 343,000 from just the last quarter. That said, Mad Money host Jim Cramer stated that Tesla has peaked in terms of its share of EVs in the United States, to which Elon Musk replied, "We shall see," which seems to be quite bullish. EV market share is a poor metric, however, especially since Tesla dominates in the country with over 65% share. Their aspirational goal is 20%, which is a decline in share, but they can still grow immensely even with declining share. Any new company that adds one EV onto the road automatically eats into Tesla's share. A better comparison is how Tesla's share looks relative to the overall car market, since in this case, every new Tesla added onto the road takes away an ICE car. Although no one seems to be worried about the legacy automakers, they're only worried about Tesla. One of the biggest bear cases for Tesla has always been that the competition is coming, and this continues to be quite popular. But just because there are other electric vehicles on the road doesn't mean consumers want to buy garbage cars. Not all electric vehicles are made equal. As a matter of fact, it was interesting that someone called in to Jim Cramer's Mad Money at the beginning of last week saying that he had a large position in Ford and he was very excited about the EV transition, so he bought a Ford Mustang Mach-E. But he went on to say that Ford had failed him at almost every point in the process, even for the most basic tasks, saying he lost confidence in them and their ability to execute. Then he says he went out and bought a Tesla and it was much better. Now Cramer says maybe the situation is anecdotal, and it likely is, but actually this isn't the first time I'm hearing this about Ford's Mach-E. They seem to have quite a few issues. While you still have to go through dealerships mostly, in terms of the buying process, the problems seem to go beyond service, where the company's ability to update software lacks tremendously, which is upsetting customers. How come it's not a problem for legacy automakers when a rushed-out vehicle is actually tarnishing the brand of the company? But Elon Musk's tweets are bad for Tesla. The traditional automotive companies are still dealing with chip shortages, battery shortages, declining sales, supply chain issues, and their cash cow businesses are in decline. They're hanging on to their earnings by jacking up prices for the same old gas cars that people are used to. But again, they are much more affected by recession. And have a look at my previous video to see how they could be drastically affected by their financing arms, which most large legacy auto companies have. The competition is certainly coming, but it's coming from Tesla. If we're entering a deep recession, legacy auto could be in big trouble, especially since they were in trouble back in 2008, before Tesla was even eating into their sales. Now, there is a perception that it's impossible for Tesla to be larger than all of the other automakers combined. It's not that much larger now anyway, since the stock has fallen so much. But Apple is allowed to be larger than all of the other phone companies that have ever existed combined. The value of a company is determined by earnings multiplied by a number that should factor in the company's growth rate. Most large tech companies, according to analyst consensus, have fairly modest growth rates and PE ratios around 25 times, give or take depending on the company. Coca-Cola is a stable company with a very small growth rate and a high earnings multiple, and even GM and Ford have low multiples and seem to have higher growth rates compared to some of these tech companies. Nevertheless, Tesla has a significantly higher growth rate than any of these companies listed, but a very modest forward-looking PE ratio. So if Tesla can continue to grow at this rate and put up strong earnings numbers, then the valuation should simply follow over time. Now, Dan Ives, an analyst from Wedbush, was recently interviewed by CNBC, and he's been fairly bullish on Tesla, though he did lower his price target to $175 as the stock fell, but maintained his outperform rating. Actually, the first video on this channel from 3 years ago, in October of 2019, called out Wedbush for having a wishy-washy price target on Tesla, basically just tracking the current price of the stock wherever it went. Dan Ives stated at the time that Elon Musk was trying to juggle too many things at the company, specifically building the Shanghai Gigafactory, tooling its Model Y at Fremont, and ramping the Model 3 in the US. His advice was cost-cutting and getting to profitability, which was the linchpin to the story. Of course, Elon Musk and Tesla successfully executed on all of these things and then some, and today the number of projects going on at Tesla has ballooned significantly, and he doesn't appear to be concerned about this right now. Yet people are worried about Elon Musk juggling Twitter, even though he's still working at Tesla. Come to think of it, people were worried pre-acquisition when Elon Musk was tweeting too much when he went to the bathroom. They thought he was losing focus on Tesla. But Elon Musk time and time again has shown that his company knows how to prioritize projects and manage time effectively. Now, Dan Ives attributes about $600 billion in Tesla's decline to Elon Musk's $44 billion Twitter mistake, as he calls it. It would be interesting to see the analysis behind that and how it relates to weakness in demand in China, a country that doesn't even allow Twitter to be used. China appears to be opening again, which will likely have a rough start as we're seeing, but should improve the economy over time. There was a data point that showed high inventory in China earlier this month, coupled with planned shutdowns of the factory. A high inventory number doesn't necessarily mean that demand is low. Tesla could be working to smooth out deliveries, as they talked about last quarter, and China is also their export hub. If there is a softening in demand, though, it would also hurt all auto companies that operate in China, many of which have ICE vehicle businesses that are quickly being eaten up by EVs. Electric vehicles appear to have over 26% market share in China and 35% including plug-in hybrids. Tesla also has multiple levers it can pull in order to increase demand, such as adding new features, giving discounts, marketing, etc. But it's hard to believe that the electric vehicle story is over, and it was all caused by Elon Musk buying Twitter and working there for 2 months. Now, people attribute the 71% drop in Tesla mainly to Twitter, surprisingly, and also the rumors of reduced demand. Even Dan Ives says that institutional investors are calling him and they're panicked about Tesla. But there might be some other factors at play, and some of it may have to do with the market mechanics. Back in 2008, Jim Cramer had a segment called Hedge Funds Gone Wild, where if investors pulled their money out of hedge funds, the funds would be forced to sell at any price essentially. And it's not just Tesla that's down right now, the entire technology cohort has been hit hard. It's also the end of the year, which means that investors can sell their poorest performing stocks to claim a tax break, and then buy the stock back later if they desire. But this could cause end-of-year selling. Now, we're also seeing another phenomenon, which was more common in 2008, and that's people getting margin called. A lot of people bought Tesla stock using borrowed funds, which ironically Elon Musk has warned against on Twitter. Part of the reason is that he himself ran into a similar issue where Twitter was partially funded by debt, which currently has a high interest rate, and it seemed like he was looking at a way to use a margin loan against Tesla in order to replace this debt. Instead, it looks like Elon Musk didn't go through with this and likely sold Tesla shares to cover some or all of this Twitter debt. It's reported that he sold on the order of $40 billion of Tesla stock this year, and Twitter was $44 billion, but other investors bought in with him for more than $4 billion. So it's likely that he has some extra cash on hand now, and he's talked about having dry powder. But this selling of Tesla stock, A, obviously puts pressure on Tesla stock, and B, scared investors away from the stock, which further pushed it down lower. It seemed like the low price triggered margin calls for those people who had borrowed money to buy Tesla, which again causes this cycle that pushes the stock down even lower, triggering more margin calls. And that could be a major factor in these huge decline days where Tesla falls 8% or 10% to new lows off little or no news. So it looks like potentially some of the biggest bulls with the most money or most borrowed money temporarily became some of the biggest negative forces on the stock. So do you think Twitter is causing real problems for Tesla, or is Elon Musk doing the right thing for both companies? And do you think Tesla is truly having a demand issue? And if it doesn't clear up going into next year, do you think Tesla will be able to handle it and once again spur demand? Don't forget to check out my last video on automotive loans collapsing. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.